Hi, and welcome to Macro Wednesday. We talk macro, trying to make sense of markets that really don't make any sense. I'm your host, Steven Van Metre, and thanks for joining me today because we're going to do something a little different than we normally do. I'm going to do an explainer video. And the reason I want to do that is because every Monday we look at this hedge fund or speculative positioning, and unfortunately yesterday I was pretty exhausted. It's a story I'll tell you some other time and why that is a problem for me. And I just didn't have the energy to go through any deeper, so it was a real short video. And then right after that aired, my friend Jeff Snyder, who I just did a great interview with Real Vision with, that will publicly air at some point. I'll get the details when the time comes. He did a whole piece on the Commitment of Traders reports, which is this speculative futures positioning. He did it on the bond market, and he did it in more detail because he has access to better, more expensive systems that can aggregate the data into charts that I don't have. And so I want to go through that with you and show you why it's so interesting and how people can look and say, how can you possibly be bond bullish? Interest rates are going back up. When you see this and you really start to understand it, you go like, oh, I get it. It'll make perfect sense. Now, before we do that, some of you have messaged me saying that you've been getting some phishing emails about some cryptocurrency or Bitcoin investing opportunity where it wasn't for me. So just so you know, I don't do those things. I don't even know how they get your email address, and I wouldn't know how to get it either. So it definitely did not come from me. So if you get one of those phishing emails, please don't click on it. Please delete it. And if there's somewhere you know how to report, some place to report it to, by all means, please do that. Okay, so what's the deal with the bond market? Obviously, we know it's been selling off because the speculative selling is very aggressive lately. But what's the bet? I mean, let's just sit down and say, who's on what side and why? What is their motivation? So on one hand, you have people that believe inflation is coming. On the other hand, you have people that believe deflation is coming. People that believe deflation coming are in a minority compared to the people that believe inflation's coming. I mean, everywhere you turn, every media outlet, every news channel, it's all about inflation, inflation, inflation. And why is this bet almost obvious to some people? Well, they think when the government borrows money, it's inflationary. It's not at all. Money is created when consumers and businesses borrow money from banks. The federal government doesn't borrow money from banks. Now, I do understand they borrow, the primary dealers are involved in this, but you have to understand the primary dealer's role is to do exactly that. They're a dealer. Their job is to, go to auctions, bid on whatever they want, and then buffer that out to other people who want to buy it over time. It's simply because we have Treasury auctions once a month. And, rather than have them every day to meet the demand, it's much easier just to have them once a month. Allow the dealers to come in, use their warehousing rules, which Jeff and I talked about, to create money in the very short term. And then as they sell their inventory, money is destroyed. So it's just a buffering mechanism. Think of it like you're shoving stuff down your garbage disposal, and you cram a bunch of stuff down, and then you turn it on and it goes, and then it goes berserk. No, what do? You turn the water on, and you start shoving stuff down there with it on, and if it starts to bind up a little bit, you wait until it chews through it, and then you put some more. That's what the primary dealers do with the bonds they get from the Treasury auction. And the reason they buy them, because you have to think of a primary dealer as a retailer. Why would they buy something if they thought they were going to sell it later at a lower price? They wouldn't. That's the part a lot of people really miss. So you have the primary dealers buying to resell to the public. You have U.S. bidders, and then you have foreign bidders, which are mostly foreign central banks. Those are the people that show up in the auctions. So no money is created. It's just borrowed from the existing system. But everyone thinks that's inflation. So what else do they think is inflationary? Well, they think government stimulus is inflation, right? We hear this all the time. Oh, well, if we get stimulus by the name stimulus, well, it's got to be stimulative. But that's not true either. I mean, we saw Obama's stimulus package wasn't stimulative. The recent one wasn't stimulative. But the next one, it's always the next one will be. But when you understand that when the government borrows money, it borrows dollars from those who have it and it redistributes in idea to those who pretty much don't. Now, if you think of what the purpose of the stimulus is right now, it's to get money in the hands of people who need it. Now, there's 26.5 million Americans receiving some form of unemployment benefit. The way money is created is, again, when consumers and businesses go to banks and borrow money. Can you guess what people on unemployment can't do? Right, they can't borrow money. What do they need the money for? Pay living expenses and their bills, right? Their debts. So, living expenses, bills, debts. They're not, someone on unemployment is like, oh man, I got a stimulus check. I think I'll run down to the electronics store and buy a new TV. That's not going through their mind. They're thinking, how am I going to get through next month, the month after that, until jobs are created so I can go back to work. So redistributing money to people with unemployment is not stimulative because they're not going to go out and use it to borrow money to spend on discretionary goods and services. And what about the people who are getting stimulus checks that do have jobs? What are they doing? They're paying off debt. And why would they do that? Because they think their job might be at risk. If your customers are going away because they're all out of work, guess where your income's going? Down. So stimulus is not stimulative, especially when it has to be borrowed by the federal government, because guess what the government has to do? Pay that debt back. And the more dollars the government needs in the system, the fewer are left for you and I. But everyone believes that's inflationary. How about quantitative easing, right? We've heard a million times from everybody that quantitative easing is some form of money printing, even though no one's really sure how. It's money printing. Even though it's not, I've proven it to you. So you have three areas that people look at and go like, there's going to be not just inflation, there's going to be not just high inflation, there's going to be so much inflation, it's going to go crazy, and it's a no-brainer deal. Now, if you really believe that inflation is coming, what is one of the easiest bets you can make? You bet against the bond market. You short the bond market. You bet on higher interest rates. Because how could you go wrong if you got government borrowing, stimulus, and QE, right? You've got every possible thing that could be inflationary in the minds of investors, even though none of them are. So it's a no-brainer bet. Now, on the other side of the fence is potentially the other no-brainer bet. Government borrowing actually does not lead to inflation, because you've looked at the charts that I've shown you and say, hey, look, the more the government borrows, the less inflation you get. You also know stimulus isn't stimulative because there's so much debt in the system and there's so many unemployed people, and none of the other stimulus packages have been inflationary, that the probabilities that this one will be inflationary at all are next to nothing. And then you also know the QE is deflationary until it's inflationary, because what does the purpose of quantitative easing? Is to lower interest rates. And I've shown you the report from the Fed. I've gone through the system with you and said, look, it drives interest rates down. Because what is the bottom line that we need to see to get inflation? Lending growth. We need credit expansion. And we know that's not happening. It's contracting. So you have two opposing views. One is the masses believe inflation is coming. This is an easy bet against the bond market. And then the smart money over here goes like, all those people over there are so dumb that this should be the easiest bet I make as long as I can ride it out. So let's go look at what Jeff Snyder had to say. And I'll link this in the description for you. By the way, in my office, anything that Jeff writes or does is required reading. So he does COT Blue, Commitment to Traders Report. Oh my God, the 30s. So let's go through here and find out what he's talking about. It says, for the third time since March, we hear the phrase bond route is back. Now, what is the bond route? Let me show you in a chart what the bond route is. And we will go to 30-year Treasury yields. And we'll zoom out a little bit. Here's bond route, interest rates going up. Remember, this is it. They're going to infinity and beyond. Okay, I didn't happen. All right, no, this is the time for sure. Now we've got this. This is absolutely it. And then it didn't happen. Now, okay, the first two times we didn't quite get there. This is it. Or translated by some, Steve's an idiot, Steve's an idiot, Steve's an idiot. Because that's usually what happens when this happens. People run out and say, thesis busted, Steve's an idiot, and then interest rates go down. and then interest rates go down. But this time, this is the time that it's going to change. Well, let's see what Jeff has to say about that. And all right, let's go down here and say, yeah, he says interest rates have nowhere to go but up, yet somehow all they do is go down, right? The market thinks they have to go up, but yet they go down. And we keep getting these claims of a bond drought. So he says the best place to go looking for clues is the futures pit. And you can see, he says, there's a ton more weighted in the opposite direction. What he's saying is there's people betting massively, wildly massively, that interest rates are going up. And he says, when you look at the commitment of traders reports, it says open positions, contracts. Think of bets. So here you have over 1 million bets, and we had unusual transactions with the Bank of Japan that led to the self-implosion of a computer-controlled hedge fund. Go look this up, long-term capital management, great story. The next time it gets over here, Bear Stearns fails, then Lehman fails. Then up here we've got problems again back in 2015. Remember, that led to the market correction. And now we have the great financial crisis of that he calls it, in March of this year, when these contracts were off the chart. And now they're back up over 1 million again. Now, where does he get this data from? Well, he goes to the commitment of commodity future. I call it commitment of traders. It's what it's called, but it's the Commodity Futures Trading Commission website. And he looks for the commitment of traders report. And if you scroll down, you get to the financial section here, and he's looking at this one on the right, the long format. So I'll bring that up and I'll get rid of that other window since we don't need it. And here you have U.S. Treasury bonds, open interest, almost 1.3 million positions. Again, anything over 1 million, he says, problems start to happen. Or was it 800,000? He said, somewhere he says what it is. We'll get to that. Oh, here. Above a certain level, say 800,000 contracts, it is consistently indicated serious and has turned out consistently widespread concerns. Financial agents seem to load up on long bond futures as hedges against problems since they're seen building in the near future. Now, who's he talking about financial agents? He's talking about the smart money, the banks. He's saying that the big players out there that know how the system works are hedging their risk. That's what you do in the futures market. So he goes on to say that there is a demand, and we talked about this in our interview, for U.S. Treasury securities despite everyone thinking otherwise. And he points out here that when you see a spike in open interest, you usually eventually see a decline in Treasury yields. So what is this telling you as an investor? When you see these spikes, they're called opportunities. So this is, again, I can't make these charts really any bigger. I tried to blow them up, but you can go and pull this up and look. So he's saying when you see these spikes, the generally trend afterwards is lower interest rates. So that should be a clue. Okay, let's keep going on. So he says open interest jumped to 1.1 million, is now at 1.3. And let's see. So now he's talking about the leverage money shorting these instruments. Who are these people? They are effectively your hedge funds, the hot money. These are people that have lots of money at their disposal and throw it around. He calls it the plaything of bond kings. Just on a side note, when he refers to the playthings of bond king, not this guy. He's talking about other bond kings. You'll get the idea. All right, so he says they've never been more short long bonds, and it's not even close. So look at this chart here, and he goes all the way back to 2010, and he shows you how much you see in people betting on higher interest rates. So this blue part on the bottom, everything under the zero baseline is how many contracts are betting on higher interest rates. Now, if you were going with the trend, well, then you would go and bet on higher interest rates. If you were contrarian and saw that, hey, all these people betting on one side of the fence are going to lead to something else, well, then you're going to be very excited about that chart, because the way the market works is simple. When you have a lopsided view, when so many people are on one side of the trade, what eventually happens? They get smashed out of that trade because the big players just let them get deeper and deeper into those positions, and then they come in and eat their lunch. It's always how it's been. So if you look at this chart again, It's telling you that there are now somewhere around 400,000 contracts net short. Now, how would you know that? Well, you could go back to the Commitment Traders Report here. Now, I am not the foremost expert on these. If we need someone smarter, I will bring them on. I know enough about this to know what it means, but I don't know the details of every little thing. So down here we have Ultra U.S. Treasury bonds. I don't know if these are zeros, but coupons or not. But here you see leverage funds, right? Leverage funds short. Leverage funds short. And what do you see? 500,000 contracts on Treasury bonds, 410,000 on Ultra Treasury bonds, very, very long-term bonds. So you're saying, look, these people are betting against this in the biggest way in history. This is the largest short position ever. And it's not just on that. If you go down here and look, here you have the 2-year bond. You have almost 900,000 contracts. Here you have the 10-year. This is the least offensive one at just under 700,000. How about Ultra 10-year, 200,000 contract? That one's not bad. How about 5-year, almost 1.4 million? How about, well, that's about it. There's probably some more in here somewhere. But you get the idea that everybody is betting against these things in a big way, the biggest way in history. Now let's go on. He points out that, hey, there's sometimes that when there are short positions, that those short positions do lead to a backup in interest rates. He doesn't say that that will happen here, but let's go and examine this. So here we see late 2010. So the first thing we need to do is go and look at what's going on with quantitative easing. Well, quantitative easing 1 ended in March of 2010, and QE2 restarted in started in November of 10 and ran through June of 11. So in late 2010, QE restarts. Why might that be? Well, it's possible because interest rates were starting to go up. The question then is, why were they going up? So we know the answer that is Fed wanted to stop this trend, but why were they going up? Well, if we go to loans and leases in all commercial banks, what do we see? The year-over-year rate in late 2010 was growing and getting up to, almost 1% on a year-over-year basis was a big improvement over this, collapse. So there was a demand for loans. People were borrowing money, and there was an expansion in currency from this. So expansion in debt is what you want to see. And when you get an expansion of debt, you tend to get higher interest rates. And the Fed says, no, we need to put the brakes on that. And what happened? QE2 comes in and puts the reverse on that. I want you to understand how QE plays a role in this. Now let's go out to January of 15. Was there any QE going on then? Well, the answer is no. QE ended in December of 13. So we'll be done with that tab. Let's go back and say, okay, well, what happened in roughly the 6 months of between January 15 and 16? What was going on? Well, again, you come back to what was going on in the credit markets. You have all loans and leases growing at 7.5%, almost 8% on a year-over-year basis. There was a massive demand for loans, and so that drove the market, which is phenomenal. That's what you want to see. But interest rates went down again. Here we are again. Now, could this lead to a move higher in interest rates? It is possible, but it is also highly unlikely because the mistake that the Fed made in March when they did that big $1 trillion QE, they did it all in Treasury bills. And the bank said, no, bad Fed, bad Fed. No, Jay Powell, you don't do that. Don't take T-bills. We want T-bills. So what did they do then? The Fed said, fine, we'll stop doing QE on the T-bills. We'll do it only on notes and bonds and tips and mortgage-backed securities. So the base of the U.S. Treasury QE part is mostly notes and bonds and a tiny bit of T-bills, or not T-bills, tips, inflation-protected securities. No T-bills. We've looked at this for no T-bills. All right, so now we know that QE is in the right mode. It is buffering this. But why have we seen interest rates go down or up recently? Why has this happened? right here in the charts. Why did we see this? Because the Fed can't handle, the Fed is mopping it up. The market is mopping up as much of this, but it's still not enough to handle the overwhelming dumping of these large contracts onto the market. Now, some of you might ask, well, wait a minute. You said before, for every one side of the futures market, there's another side. Aha, yes, there are. Let's go take a look at that right here. So I think, here he's got it right here. Sometimes it's pretty cool when I do that. Doesn't happen often, but here you can see the long and short, a mirror image of it. Now, how do you see that on the Commitment of Traders report? Well, here on the other end of the bet is your asset manager institutionals. These are your banks, large money managers. These are the smart money. And look, you see long, 650,000 contracts. Over here, you see this. And there are other, it all eventually balances itself out, but you can see they're long. They are generally, except for here, they are generally long the bond market. So the smartest players in the room are long the bond market. The hot money or the speculative money is short the bond market. That should tell you something of what the problem is. Now he goes on here and he's talking about smaller players being short. Where do you see smaller players on the report? These called other reportables right here. And for some reason, even small, other reporters will be people like you and I who are specking on this. Just people are just small enough that their positions aren't really large, but together they add up. And for some reason, even they're participating on the short side. And that is not the best side to see them, because when they're on the short side, the market tends to go the other way against them. So he's saying, look, you've got all these long future open interest in the futures market. He said the net position is wrong for reflation. The total net jumped positive in the week of June 9, the last top of yields, and since August 25th, positioning is going the wrong way again. The direction that is consistent with the same sort of anti-reflation lid on yields the market has imposed despite these intermittent screams of bond rout. Now, what does he mean by anti-inflation lid on yields? Remember how we talked about that when interest rates go up, lending demand dries up unless, it is drying up. So the higher rates go, the fewer people that want to borrow it. Well, what are we seeing at all loans and leases now? On a 3-month and 6-month basis, it's negative. And the year-over-year rate, which we can go look at, which is coming down, we'll zoom in, is pretty weak at 5.8%. Historically, and it's only because of this move here. Before that, it was at 4.1. But if this 3 and 6 month are negative, guess where the year-over-year rate is headed? It's headed -2. Not to -2, negative also. So he kind of says what's going on with this, and you can read the rest of it. But the key here is when you see this chart, right? I want you to spend some time looking at this chart here. And if you look at this and say, man, interest rates are going to go way, way up, I want you to understand that this is the largest speculative positioning against the long bond in the history of the bond market. And if you've got this many bets against you, right? If that's what you've got, and the best you can do is not even get back to the 2 prior highs, who is going to lose? Now you say, but Steve, there's really no demand in the bond market, really. Well, let's go to today's auction on the 10-year. It was a reopening. So this is a tie for the second largest 10-year Treasury auction offering in history. And what do we see? Primary dealers bidding almost $52 billion against a $35 billion offer. Why would the primary dealers, who even though they're required to bid, do not have to bid that much, want 10-year Treasury bonds? Because they know they're going to sell them at a higher price. They know there's demand for them and they want them. Does this start to make sense? This is what's really going on in the market. And here's the other factor that you can't just see from this. If you know the economy is rolling over and getting weaker, and it is going to, what is the Fed going to do? They're going to do more QE, but they're not going to do it in the T-bill market. They're going to do it in notes and bonds. And think about it. When you have all of these people here, I just want to keep hammering away at this chart. When you see this many people betting against you, How many more bets are they going to make before they realize that they're already overextended in their position and they're losing because the credit markets are going against them? The stimulus won't be stimulative. The government borrowing isn't stimulating. QE causes interest rates to go down. So if QE causes interest rates to go down, all these people are on the wrong side of the fence. They're betting against the wrong thing. And the credit data tells us that. So the question is when you see the biggest bet against the bond market in history, you don't worry about the day-to-day move, because what will eventually happen is there will be the largest short squeeze in the history of the bond market as these people find out they're wrong. And someone, or several people, I think, pointed out on Twitter and tagged me and said, well, Steve, when there is this short squeeze, when they get squeezed out of these positions and start to have to buy these positions back out because interest rates go back down, isn't that going to trigger a demand for dollars? Oh, yeah. And isn't that really interesting? When we think about there being a global dollar shortage and the dollar is really low, well, really low relative to the last, say, 5 years, and is making a bottoming pattern and looking to go higher. Does it start to make sense on how this plays out? Not only do you get a massive short squeeze in bonds, but as these players look to buy bonds, they're going to need dollars. Well, guess what? They're not going to be able to get them either. There's going to be a demand for dollars, sending also not only interest rates down and bond prices higher, it's going to send the dollar higher and cause this whole thing to get unwound. And that, my friends, is how the smart money makes money. They get everybody off sides and then they eat their lunch. Because, again, you not only do you have the economy working in your favor on this, you have the Fed. I hope today's video was worth it. I know it's a little different than the rest, but I think for me, I enjoyed it, and I hope you enjoy it. Hope you learned a lot, and I will see you definitely on Friday, where we'll probably get things back to normal. Look at the credit data, which we know is probably going to contract even more. I'm Steve Van Metre. Bye now. The content of this video is provided as education and information only. Is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by or sell security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.